Welcome to the jungle, the business world where the rules are murky and the stakes are high. You know the big names: Apple, Amazon. Buying their stocks is public investing, simple, hands-off, and a bit like owning a single Lego brick from a massive Death Star set. But what if you wanted to own the whole Death Star? That's private equity. Private equity, or PE, is about buying entire companies, ones you won't find on the stock market. Think of public markets as a supermarket anyone can shop in. Private equity is a secret auction for entire supermarket chains. The buyers? Specialized firms with deep pockets, aiming to overhaul companies and sell them for a profit. It's hands-on, aggressive, and involves staggering sums of money. Why does it matter? Because PE firms buy and sell companies you know, your local grocery chain, a factory in your town, even your favorite sock brand. They move companies like chess pieces, shaping the economy behind the scenes. Understanding private equity means understanding who really holds power in business. It's not just about picking stocks, it's about knowing the players who buy the whole board. So, where do private equity firms get billions to buy companies? Not from a single billionaire, but by raising a fund. They pitch to institutional investors, pension funds, university endowments, insurance companies, sovereign wealth funds, and ultra-wealthy families. These investors, called limited partners, hand over huge sums, expecting big returns. Once the fund hits its target, the firm, run by general partners, goes hunting for companies to buy. The firm uses other people's money, or OPM, to make massive deals. Limited partners are passive, the firm does the shopping and deal-making. The goal: find undervalued companies, buy them and boost their value. Private equity firms are expert managers, using their war chest to reshape entire industries. But remember, every credit card bill comes due. With cash in hand, private equity firms go shopping, not for perfect companies but for fixer-uppers. They target businesses with potential but big problems: outdated management, high costs, or missed opportunities. The strategy? Overhaul everything, cut costs, streamline operations, and often reduce jobs. They might bring in new leadership or invest in growth, expanding into new markets or launching new products. Sometimes they merge several companies into one dominant player. The goal? Dramatically increase value in 3 to 7 years. Private equity isn't about nurturing, it's about rapid transformation. Think of them as intense trainers, pushing companies to peak performance for a big sale. The focus is singular: maximize returns for investors. Private equity firms don't hold companies forever. The goal is to sell for a big profit. The exit is the moment of truth, and there are 3 main ways out. First, an IPO: the company goes public and anyone can buy shares. Second, a secondary buyout, selling to another private equity firm for a new round of changes. Third, a strategic acquisition, selling to a larger corporation in the same industry. Strategic sales are often preferred: quick, clean, and lucrative. How do PE firms get paid? They charge a management fee, about 2% of the fund. But the real money is in carried interest, usually 20% of the profits after investors are paid back. This 2 and 20 model drives them to chase huge returns. If they make investors rich, they get fabulously wealthy too. Private equity is controversial. Heroes to some, villains to others. Supporters say PE firms rescue struggling businesses, make them efficient, and save jobs in the long run. Critics call them vulture capitalists, accusing them of loading companies with debt and slashing jobs for quick profits. Leverage buyouts often leave companies with heavy debt, making them vulnerable in tough times. Layoffs are common, fueling accusations that PE prioritizes short-term gains over long-term health. Some deals save companies, others hollow them out. The impact depends on the firm, the company, and the economy. Understanding private equity is essential. It shapes the businesses you work for and the products you buy. Stay curious and think twice when you hear a company's gone private. For more business deep dives, subscribe to Entrepreneurial Edge.